What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. It's no secret that 2022 has started off as a terrible year for the stock market, especially high-growth technology stocks. The tech-heavy QQQ index has lost 1/4 of its value, marking the worst drawdown since the pandemic hit in March of 2020. And pretty much no stock is safe. Even Amazon, which had previously been considered a bulletproof Nasdaq stalwart, has declined by 40%, giving back all of its pandemic gains. That's a pretty insane development. Amazon was one of the biggest beneficiaries of the pandemic with the surge of e-commerce, yet even they cannot hold on to their gains. Market crashes like the one we are currently facing are very scary, and it's impossible to tell when we've hit a bottom. But as Warren Buffett says, be greedy when others are fearful. With so much proverbial blood on the streets, we could be witnessing a generational buying opportunity for high-growth companies, but have been thrown out with the bathwater in indiscriminate selling. I recently opened a new account with the commission-free stock brokerage Moomoo. Moomoo is a commission-free trading app which has the most comprehensive set of fundamental and technical investing tools of any brokerage I've tried. They're currently running a promotion where you can get 1 free stock when you deposit $100, and an additional 3 free stocks when you deposit $2,000 or more. Just click the link in the description below. I deposited $2,000 into my account, which I'll use to buy the dip on 5 stocks. Throughout the year, I'll update you all about the performance of the portfolio on the YouTube community tab, and we will also keep track on our website wallstreetmillennial.com. This video is not financial advice by any means. I just want to share with you my own investing rationale and how I think about investing today. This doesn't mean that you should necessarily own the same stocks. Every individual has their own time horizon, risk tolerance, and opinions. You should do your own research and talk with a professional to see what portfolio is right for you. When trying to find undervalued stocks, the most obvious place to look is the stocks that are down the most from their highs. In the current market crash, these would be the disruptive innovation stocks, such as the ones owned by Cathie Wood's ARK Invest. However, most of these companies are cash-burning machines. They're probably years away from making net profits. Burning cash in pursuit of hypergrowth was a fine strategy when the Fed was pumping the economy with free money. But now that the Fed is raising interest rates, these stocks are getting crushed like soufflés under sledgehammers. Take Teladoc. The stock is down 90% from its all-time highs. But the company is losing money, so it doesn't even have a price-to-earnings ratio. When a company doesn't make any money, it's very difficult to say that it's undervalued no matter how low the share price falls. In an inflationary and rising rate environment, you generally want to own companies that are generating cash today. That means that they can fund their operations and growth activities without needing to borrow money as borrowing costs are rising. Fortunately, with the sell-off, there are many profitable, highly cash-generative technology companies which have also seen their share prices destroyed. When analyzing stocks, I like to keep things simple. The simplest and most important metric to look at is the price-to-earnings ratio, or PE. This is nothing more than the price of the stock divided by the earnings per share. This basically tells you how much earnings you are getting for each share that you buy. For a low-quality company such as a brick-and-mortar retailer, the PE will be low because the earnings are expected to decline over time. For a company like Tesla, the price-to-earnings ratio will be very high because investors expect the earnings to increase over time. The holy grail for value investors is to find a stock with a low PE ratio, but is also growing its earnings, or at least the earnings won't decline. Fortunately, with the recent market crash, there are more and more companies that fit this description. And that brings us to my first pick for 2022, which is Meta Platforms, formerly known as Facebook. We can use the Moomoo app to analyze the PE ratio of stocks. On the login page, we click the search bar at the top right and type in FB, which is Meta's ticker symbol. We then swipe over to the Analysis tab. Scroll down and look at the company valuation section, which shows you not only the PE ratio today, but also how it's evolved over time. Currently, Facebook has a PE of 15, which is already slightly lower than the S&P 500's PE of 20. Interestingly, you can see that back in 2020, Facebook's PE was in the 30 range. The PE ratio has fallen from 30 to 15, which basically means that the market thinks that Facebook's growth opportunities are 50% worse than they were 2 years ago. If you want to buy or sell shares of Meta, you just swipe over to the Quote tab where you can see the stock price chart and tick-by-tick values. What's really cool about Moomoo is when you go to place your order, you can see the entire order book and see what is the best bid and ask price for the stock right this second. This is called Level 2 market data and is really important to get the best execution on your limit orders. Moomoo gives this to you for free while many other brokerages make you pay for it. The question is this massive decline in valuation reasonable, or is the market overreacting? Besides the general change in market sentiment, there are 2 main reasons that the share price has been cut in half. The first concern is that the company is facing increasing competition from TikTok, the short-form video app which has seen its popularity explode in recent years. I view this fear as overblown. People use Facebook and Instagram to see what their friends are up to and organize various online and in-person events. On TikTok, you watch random influencers who you don't know personally, dancing or doing various comedic stunts. If anything, this is more of a competitor to YouTube than Facebook. Their active users continue to grow, and today 3 billion people around the world use at least one of their 4 apps: Facebook, Instagram, Messenger, or WhatsApp on a monthly basis. The second major problem is Apple's recent privacy update, which will make it harder for Facebook to target ads. Despite this headwind, they were still able to grow their revenue by 6% in the first quarter of this year. If there's one thing that Zuckerberg is good at, it's mining your personal data. Whatever privacy systems Apple tries to put in place, I believe he will find a way around them and continue creating value for his shareholders. At just 15 times earnings, I believe that Facebook represents a rare opportunity to invest in a highly profitable and growing tech company at a more than reasonable price. The second stock that I'm buying on the dip is the AI lending platform Upstart, which is revolutionizing the loan approval process. Today, most banks rely on your FICO credit score to decide whether to approve or reject your loan applications. The problem is, even if you've never defaulted on a loan, your credit score may still be low simply because you don't have enough credit history. Founded by former Google executives, Upstart uses a machine learning process with over 1,600 inputs to predict the probability of a default with much greater accuracy than a traditional FICO score. Upstart partners with both banks and car dealerships to use their AI platform to approve mortgages and automobile loans. Upstart's AI prediction model approves almost triple the number of applicants compared to legacy systems, and would have 75% less defaults at the same approval rate. This is a win-win for both the banks and the borrowers. This past Tuesday, the stock price was more than cut in half after releasing a disappointing earnings report. It is one of the worst performing stocks in the entire market, having lost more than 90% of its value since its all-time highs just a few months ago. There are two possible scenarios. Either their business is rapidly deteriorating, or Mr. Market is giving us a massive opportunity to buy this stock at a 90% discount. We can analyze Upstart's financial performance with the Moomoo app. We open the app and type in the ticker symbol UPST in the search bar. Once we get to Upstart, we scroll over to the Financials tab on the top. This page shows us data from Upstart's financial statements. The first thing to look at is the company's revenue growth. Since 2017, Upstart's revenue has grown every single year. In 2021, their growth exploded, with revenue almost quadrupling to $846 million. Of course, revenue growth is only useful to the extent that it can be translated to profitability. If we click the net income tab, we can see that they are basically break-even over the past few years, but in 2021, their net profit skyrocketed to $135 million. Moomoo also keeps track of analyst estimates. Over the past 4 quarters, Upstart has exceeded revenue estimates. They've also consistently exceeded earnings per share estimates. So far, everything looks pretty good. Now, to understand what's going on with the stock price, we can go over to the Analysis tab. In the Company Valuation section, we can see how Upstart's PE ratio has been crushed. At the peak 2 years ago, their PE reached a peak of almost 2,000. This indicates that investors were very bullish on the company's future prospects. Today, the PE is 20, down 99% from the peak. Moomoo calculates that the current PE is in the 0th percentile historically. That means that Upstart stock is cheaper today than it's ever been in the past. We can also look at the short interest. The gray line is the stock price and the blue line is the short interest. As the stock price has declined, hedge funds have been shorting the stock hand over fist. Currently, 24% of the shares have been sold short, which potentially makes the stock vulnerable to a short squeeze. So why are investors so bearish on the company despite the skyrocketing revenue and profitability? They gave 2022 revenue guidance of $1.25 billion, which represents 47% growth over the prior year. While 47% is an insane growth number in its own right, it's a deceleration from the 264% of 2021. In 2021, Upstart was helped by unprecedented low interest rates set by the Federal Reserve to combat the pandemic. Mortgage originations skyrocketed as homeowners wanted to lock in the low rates. Now that the Fed is raising rates, mortgage demand is declining to more normal levels. Despite the interest rate headwinds, Upstart is continuing to sign on new partners at a rate of 1 per week. Today, 57 banks and 525 automobile dealerships use Upstart to approve loans. This is a tiny fraction of the almost 5,000 banks and 140,000 automobile dealerships in the US. Given the massive addressable market and proven track record, I think that a 90% decline in Upstart's share price represents a generational buying opportunity. The next stock that I'm buying is Warner Bros. Discovery, or WBD. WBD was formed about 1 month ago by a merger between Warner Media and Discovery. Warner Media owns the streaming service HBO Max, while Discovery owns Discovery Plus. WBD will combine the two services to create one dominant streaming service to compete with the likes of Netflix and Disney+. The combined streaming platform will have 100 million paying subscribers, making it the fourth largest video streaming service outside of China. Amazon Prime Video is not really comparable, because many people subscribe primarily for Prime delivery. If you look at the pure play streaming services, only Netflix and Disney+ will be bigger than WBD. My belief is that the streaming landscape will consolidate around Netflix, Disney+, and the new HBO Max. The smaller players like Peacock and Paramount Plus lack the necessary scale to be competitive, and will slowly wither out and die. HBO has a huge library of high-quality programming, including the DC superhero universe and Game of Thrones. Discovery owns a massive library of unscripted shows, including their namesake Discovery Channel, Animal Planet, and TLC. The combined platform will have 200,000 hours of programming, which is more than any other streaming service. In the first quarter of this year, HBO gained 3 million subscribers and Disney Plus gained 2 million for a total of 5 million new subs. In the same period, Netflix lost 200,000 subscribers. HBO and Discovery are already gaining share against Netflix, and I believe that these gains will only accelerate when they combine the two platforms. AT&T acquired Warner Media back in 2018. During their ownership, they badly mismanaged the company because the AT&T executives had no idea how to run a media company. For example, they wasted $300 million to build CNN+, which is a complete flop, getting just 10,000 viewers by the end of the first month. Longtime Discovery CEO David Zaslav was named chief executive of WBD when the merger closed this past April. The first action he took was to shut down the failing CNN+. In total, he thinks that he can cut $3 billion of annual costs by rationalizing redundant headcount and otherwise cutting excesses that have built up over the years under AT&T's ownership. The company is already highly profitable, and the stock is very cheap. Based on my estimates, they can make $3.50 of earnings per share once the cost cuts have been implemented, which would give them a PE ratio of about 5. Those are my 3 top picks for taking advantage of the current market crash. There are 2 other stocks I've also added to my portfolio: graphite electrode manufacturer GrafTech and clothing retailer Tilly's. Here you can see my Moomoo portfolio with my cost basis for each stock. I've transferred $2,000 into the account, and it takes a couple of days for the money to arrive. Moomoo gives $1,000 of instant deposits, which are available immediately. Once the remaining $1,000 arrives, I'll add to the positions in proportion. I'll be holding these 5 positions in my Moomoo account, and will update you all in the YouTube community tab about the performance of these positions over the coming months, so we can see how well they do. If you want to see analysis on these stocks, you can see them for free on our website wallstreetmillennial.com. Simply click on the portfolio tab from the homepage of the website. Remember to open your Moomoo account and get 1 free stock when you deposit $100, and an additional 3 free stocks when you deposit $2,000 or more. Just click the link in the description below. Alright guys, that wraps it up for this video. What do you think about these stock picks? Which other stocks are you buying in the current correction? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.